Hello friends, I'm back with yet another interesting video. In today's video, we're going to talk about the difference between a stock versus mutual fund versus ETF. So we'll talk about in detail. So which other instrument are best and what sort of returns and risks do have associate with all these instrument. Okay, let's talk about the stock first. So as per the definition, it says buying shares of a company, you own a piece of it. So let's look at the pros and cons. So in stocks, usually what happens? So high return potential if the company grows. So your investment will grow or your capital will grow if the share price of that stock goes up. Okay. When it comes to liquidity, you can sell and buy at any point of time during market hours. Okay. If the company does well, so you will also get dividend. So now let's look at the cons. High risk, price depends on company's performance and market sentiment. Okay, it so when you invest in stock, so there is a risk which is always associated, which is called high risk, and it requires research. You must analyze company sectors and market trends. So best for investors who want high risk, high reward, and are ready to study markets. So when it comes to mutual fund, pool investment managed by professional can invest in stock, bonds, or a mix. Professional management, fund managers make decision for you. So when you invest in mutual funds, so there is a fund manager who takes care of your money, and they do the research study. Basis upon that, they take a call to invest in which sector or which particular stock. When it comes to diversification, even a small investment spread across many assets. Variety, equity, debt, hybrid, sector specific. So they allocate the funds in such a way that they invest some portion of your capital in equity, debt, hybrid, like that. So when we talk about cons, so it involves costs, expense ratio and fees can reduce return. So the expense ratio and the fee which fund manager charges, so certainly it will reduce your returns. Lower liquidity, can sell by NAV base next day price. Okay, so whenever you buy, so the NAV will not be calculated on the same day. It will be calculated on the next day, and the same goes with the selling concept. Returns depend on manager skills, not guarantee. So your return is completely dependent on the fund manager, and again, it is not guaranteed. So let's look at mutual funds is best for whom? Investor who want professional help and diversification without actively managing a portfolio. So now let's talk about the ETF. ETF stands for exchange traded funds. So let's look at the definition, what it says. Funds that track an index, commodity or sector traded like stocks. Okay, so every sector will have its own ETF. For instance, auto sector will have their own ETF. For instance, silver and gold, and banking sector, FMCG. Okay, now let's look at the pros. Low cost, lower expense ratio than mutual fund. So the expense ratio is lower than the mutual fund. Let's look at the diversification. Single ETF can hold dozens, hundred of stocks. So in one ETF, you may have hundred of stocks. Okay, so sometimes what happens, let's say out of 100 stocks, 50 stocks do not do well and 50 are doing well. So still you will make some profit. Liquidity, can trade anytime during market hours like stock. Transparency, holding usually visible daily. Let's look at the cons. Market risk, can fall in value, you still take the same risk as the underlying assets. If your underlying assets fall, so obviously you will incur the same amount of losses. Less active management. Passive ETFs follow indices, won't beat the market. So let's look at ETF are best for whom? Investor who want low cost, diversified, and flexible trading. So basically, ETF are good for those who are passive investors who do not take out time to understand the market, and they may not have time to look at the market on a daily basis. And even if you look at the quick comparison table, it also talks about the same. So now let's understand the bottom line. High risk, high reward, and hands-on stocks. Hands-off, diversified professional health mutual fund. Low cost, diversified, flexible trading ETF. If you ask me which instrument is best for the beginner, so I would go with ETF, then mutual fund, then finally I would advise to explore into the stock if you are a beginner. Okay, let's quickly understand the visual, what it says. Okay, when it comes to individual stocks, like I said, high risk, one company falls, big loss, requires research, monitoring. So your stock can fall 50%, and similarly, your stock can go up 50%. So you may need to understand when to enter, when to exit, and you also need to time the market. So this all complexities issues will be there when you directly invest in stocks. Let's talk about the mutual fund. So diversified fund manager picks stocks. So you will have a designated fund manager who will pick a stock for you, and accordingly your portfolio will perform. High expense ratio 1 to 2%. Cannot trade instantly. Let's understand the ETF part. Tracks index like Nifty 50. Very low expense ratio. Trade like stock, buy, sell. So again, Visual also talks about the same thing. Okay, if one who is a passive investor, okay, so ETF is the best instrument for him or her to start with. So if you like this content, if you like this video, so I would request you to please do subscribe to my channel, share it, like it, and put a comment on what subject you want me to make a video. So I will do that, and we'll see you in the next upcoming video. Till then, thank you. Take care.